I'm here in San Diego. It's another rainy day in California. It seems every time I make a video, it's raining. But the question today is, what is the role of real estate in an investor's portfolio? It's an interesting and nuanced question. There's a Morningstar article that did really careful research. They analyzed 39 other studies and then aggregated all of that data together. And the results were that since the early 2000s, allocating at least 5% of your portfolio to real estate leads to higher returns in the long run, lower volatility than the standard 60-40, stocks and bond split to an investment portfolio. Everyone has a different opinion, and certainly each person should do what's right for themselves. But most academic studies say between 5% and 20% is a good allocation for real estate as part of the overall strategy of your investment portfolio. And today I'm here in San Diego at a due diligence conference for one of our preferred real estate fund investments. We do this every couple of years. We review the performance at one of these conferences. We review quarterly, but this is sort of an annual or biannual deep dive. So there's a graph here that shows in the past 46 years, a real estate blended portfolio with 15% allocated to REITs outperformed a traditional portfolio, the 60-40 split, 56% of the time. Why include real estate? Well, it's an asset that's not correlated to what the stock market's doing. So the stock market can be moving up and down. Real estate sits over as its own sort of bucket on the side. Of course, they're interconnected and they affect one another, but we use the term non-correlated asset. Reason number two is the returns are largely from income. Of course, there's growth to real estate traditionally in long cycles. There's ups and downs naturally, but the income generated is different from, say, investing in an S&P 500 mutual fund or ETF that is primarily growth-based. And the real estate cycle tends to be about twice as long as the stock or bond cycle. As things move up and down, real estate has a much longer cycle. Another thing that's a side note, when you're looking at these studies that are talking about REITs and whether you should include them in your portfolio or not, a lot of those that are biased against or speak against including REITs, those tend to have a shorter time horizon in their observation. And a lot of those were published prior to 2008, which was the big real estate financial crash. And they were looking at REITs that had much higher leverage ratios compared to the aggregate. Now, certainly interest rates are higher now, so that changes how we have to allocate and maybe which real estate investments are chosen. But the average interest rate since the 70s is about 7%. People have been properly allocated all of this time and successfully investing in real estate. So that's not really a reason to avoid this whole sector. As always, this is not a specific recommendation. We're just talking about what's available in the market. Every person has a unique case and may or may not fit in yours. So that was looking at data from Morningstar over, a 25-year look-back period of time. If you look really at the last 10 years, according to the exchange rate data, as of October 2023, the 60-40 traditional allocation has an 8.67% average rate of return. Just adding 10% of real estate gets that to 8.82%. That's about a 1.7% yield increase. But if you bump that to 25% real estate, privately held real estate, then the yield moves to 9.36. It's almost an 8% increase in your yield over a 10-year time period, not counting all of the other aspects of owning physical real estate, like depreciation and enhanced tax deduction features. Volatility is down. In a traditional 60-40 portfolio, volatility averages about 11.2%. With 25% allocation to real estate, that's down to the low 9%. It helps. So let us know if you'd like more information on this and how you can add real estate to your asset allocation mix and your portfolio.